In part 1, I left you with a question. HDFC Bank, profits growing, loans growing, bad loans at lowest in years. Yet the stock is down 15% in 1 year. The chairman just quit citing ethics. Management is saying NIM recovery will take 2 to 3 years. So which is it? Temporary pain or something deeper? Now we go into the numbers, because in banking, if you know where to look, the story becomes very clear. So let's start with the income statement. The profit number and why it's misleading. In last financial year, FY25, HDFC Bank reported a net profit of 67,000 crores. That's up about 10.7% from the previous year. So on the face of it, profits are solid. And that's the headline people see and move on. But here's the problem. Profit growth alone tells you almost nothing about a bank. What matters is how the profit is being generated and whether that generation is sustainable. And when you start pulling the income statement apart, a very different picture starts to emerge. First is net interest income, the core engine. Net interest income, or NII, is simply the interest bank earns on loans minus interest it pays on deposits. It's the purest measure of a bank's core business, and in Q3 FY26, NII grew by 6.4% year on year. Now compare that to how this bank used to grow. Pre-merger, HDFC Bank was regularly posting NII growth of 20 to 23, even 25% year on year. That was compounding machine everyone fell in love with. Today, it's 6.4%. That's not a collapse, it's a significant slowdown in the engine. Why? Two reasons, and both connect back to the merger. This is the metric I want to spend the most time on, because this single number explains almost everything that has happened to HDFC Bank since July 2023. The net interest margin, or NIM, is the spread between what a bank earns on its loans and what it pays on its deposits, expressed as a percentage of total assets. Before the merger, HDFC Bank's NIM was 4.1%. Some quarters it touched 4.4%. That was best in class for a bank this size in India. Today, as per Q3 FY26 official investor presentation filed by the bank, NIM is 3.35%. That's a fall of roughly 75 to 100 basis points. Now that might sound small, but in banking, margins work on enormous balance sheets. HDFC Bank has a total assets of 40 lakh crores. A 1% difference in NIM on that basis 40,000 crores in annual income. Gone. This isn't a one-sided problem, it's a pressure from the both ends of the balance sheet at the same time. So what happened? Two things hit simultaneously. Problem number one, the cost of funding went up. Before the merger, HDFC Bank funded itself mostly through deposits, like your saving account, current account, and fixed deposits. These are relatively cheap sources of money. The bank cost of funds was around 3.9%. HDFC Limited was completely different. It funded itself through bonds, debentures sold in the market, institutional money. The cost was around 6.7%, almost double. When the merger happened, all of the HDFC Limited borrowing came into HDFC Bank's balance sheet. Overnight, the blended cost of funds spiked. It peaked at 4.9% post-merger. As of Q3 FY26, cost of funds has came down to 4.5%. That's a progress, but it's still meaningfully higher than where the bank was before. Problem number two, yield on assets fell. HDFC Limited's main business was home loans and mortgage lending, and the home loans are low yield assets around 8.5% to 9% compared to personal loans at 14%, credit cards at 36%, or business loans which can go even higher. So the merged banks suddenly had much larger proportion of low yield mortgage assets on one side and higher cost of borrowings on the other. Both forces pushing the NIM in the wrong direction at the same time. From the official presentation, yield on assets today is 7.8%. It was 8.3 a year ago. That is still falling. So the spread Yield on assets minus cost of funds, which determines the NIM, is being compressed from both ends simultaneously. That's the core problem. And guess what the management said on the Q3 earnings call? That it will take 2 to 3 years to recover. The moat that quietly disappeared. Now, I want to talk about something that gets even less attention than NIM. And I think it's actually more important for the long term. The CASA ratio, current account and saving account deposits as a percentage of total deposits. This is the measure of how much of the bank's funding comes from cheap, low-cost deposits like salary account, business current account versus expensive fixed deposits or market borrowings. A high CASA ratio is a bank structural moat. The higher it is, the cheaper your funding, the better your margins, the more profitable you are. Simple as that. Now, before the merger, HDFC Bank had a CASA ratio of 43 to 44%, one of the best in the Indian banking sector. That was the foundation of its premium valuation. Now, if you look at today, the CASA ratio is 34%, and here's what makes it alarming. It's been stuck exactly at 34% for 6 consecutive quarters, not improving, just stuck. And without CASA ratio improving, the NIM recovery becomes much harder than the management is guiding for. You'll ask me why? Because HDFC Limited had zero CASA. It was entirely a wholesale funded entity. When it merged, a massive pool of fixed deposit and borrowing came onto the balance sheet, and that instantly diluted the CASA ratio from 43% to 34%, almost overnight. The bank has been working to rebuild it, adding branches, deepening customer relationships, pushing current account and saving account growth. But the scale of the balance sheet is so much larger now that rebuilding the ratio is genuinely hard. Now, here's a detail from the Q3 earnings call that I found very revealing. The CFO explained that retail individual CASA ratio is actually growing in double digits, meaning individual saving accounts are healthy. The problem is non-individual bulk deposits like institution, trust, capital market participants. The bank is deliberately not matching the competitor rates to attract this money because this money is expensive and comes with no loyalty. So the bank is making a conscious strategic choice to protect the cost of funds, even if it means slower deposit growth overall. That choice is reflected in the CASA ratio staying flat. Now, the question is, can they rebuild it to 40% plus over the next few years? Because if they can, NIM recovery becomes a real story. If they can't, this is a structurally low margin business than what the market priced in for 25 years. The number RBI didn't like. One more ratio, credit to deposit ratio or CD ratio. This is simply for every 100 rupees of deposits, how much money the bank has lent out. Before the merger, HDFC Bank operated at a CD ratio of around 85 to 87%, comfortable and healthy. Post-merger, this spiked to 110%, breaking the bank's own historical comfort zone. The bank was lending out 110 rupees for every 100 rupees it had in deposits, funding the gap through market borrowings. The RBI clearly wasn't comfortable with this and signaled informally that the bank should bring down this ratio. The bank heard this message, and for last 18 months, it has been prioritizing deposit growth over the loan growth. As of today, the CD ratio is approximately 96%, better than 110%, still above the pre-merger level of 85 to 87%. But here's the nuance, and this came directly from the CEO on the earnings call. He said, and I am paraphrasing closely, open quote, "There is no regulatory number we are required to hit. This is our own internal target for sustainable profitability," closed quote. The bank's target is 90 to 96% for FY26 and 85 to 90% for FY27. Now, the interesting tension is this. At the same time, the management is saying they want to grow loans at 2%, faster than the system in FY27. System growth is expected at 12 to 13%. So HDFC Bank wants 14 to 15% loan growth and simultaneously bring down the CD ratio. And for both to happen, deposit growth needs to accelerate meaningfully. That's the execution challenge sitting in front of the management right now. Now, let's talk about numbers which are actually fine. Now, to be fair, and this is very important, that not everything is broken. And let me tell you what actually is working. The asset quality is genuinely excellent. The GNPA, which is gross non-performing assets, is at 1.4%, excluding the agricultural loans, which is at 0.97%. The CEO himself called it a Cinderella phase for Indian banking on the earnings call, if we remember for the first video. Bad loans are at decadal lows. Credit cost, what the bank provisions for the potential loss, are running about 37 basis points. That's low and stable. Then second is return on assets. ROA is at 1.9%, and here's what remarkable. It has been between 1.87% to 1.94% for the last 10 straight quarters. Through the merger chaos, the NIM compression, CD ratio problems, the ROA has not moved. The management has explicitly chosen this as the North Star. Their long-term range is between 1.9 to 2.1, and they are already in it. Capital adequacy is also very strong. Capital ratio is at 19.9%, CET1 as 17.4%. The bank is not capital constrained. It is a muscle to grow when it chooses to. And the one number from the official filing that almost nobody is talking about is borrowings as a percentage of total liabilities have fallen from 21% in September 23 to 13% today. That means the bank has quietly replaced a huge chunk of HDFC Limited's expensive bond market borrowings with the cheaper bank deposits. The integration is actually working, just slowly. Now, let me bring this together, and what does the financial picture actually say? The bank is profitable, growing, asset quality is pristine, capital is strong, ROE is holding, but the engine, the NIM, has structurally compressed, and the timeline for recovery is measured in years, not quarters. The CASA mode has been diluted and hasn't recovered since last 6 quarters. ROE has fallen from 16 to 17% pre-merger to 13.9% today, and the NII growth, which was 20% plus for years, is now sitting at 6%. This is not a bank in crisis, but it's a bank in transition, a very, very long and expensive transition. The numbers tell us what is happening, but they don't fully explain why. Is it just the consequences of absorbing the HDFC Limited, or is there something about the management, the competition, the industry structure that is also contributing to it? And that's part 3 for you, the reality. We look at the management, the competition, and what the future actually looks like for this business. Let's see you in part 3.